Welcome to this explainer. Okay, today we are tackling a massive financial myth. I'm talking about the idea that you need to be wealthy or have thousands of dollars just sitting in the bank to even think about investing. Honestly, that simply isn't true. Over the next few minutes, we're going to completely dismantle that misconception and give you a highly actionable, super straightforward blueprint for starting your investing journey with just 100 bucks. So think about this for a second. What if just $100 could be the literal first step toward building real, lasting wealth? We so often look at a single $100 bill as, just grocery money, or maybe a dinner out, or a new pair of shoes. But if you frame it differently, that exact same bill is a ridiculously powerful tool. It's essentially the seed of your entire financial future. 10 grand. For a whole lot of folks, this right here is the big mental roadblock. Many people just wait and wait, thinking they need to save up $10,000 or more before they can even dip a toe into the stock market. But the source material we're looking at today makes it incredibly clear. Waiting is a huge mistake. The most powerful force in investing isn't having a giant mountain of cash to start with. It's just starting early. Because of compound returns, small investments that you make consistently over time will often vastly outperform a massive lump sum that you waited years to finally invest. All right, so how do we actually pull this off? Let's dive into the blueprint. First up, preparing to invest by setting up your safety net and tools. Before we just toss that $100 into the market, we really need a responsible, risk-averse foundation. Step one is actually building an emergency fund. Why? Well, if your car breaks down or a random medical bill pops up, you're going to need cash on hand. If you don't have it, you might be forced to sell your investments at a loss just to cover everyday life expenses. So a simple emergency fund protects your long-term future. Step two is opening a brokerage account. You'll want to look for a modern platform with low fees, strong security, and an easy-to-use mobile app. And crucially, you need a broker that lets you do step three, buying fractional shares. See, you don't actually have to buy a whole share of an expensive company anymore. Fractional shares let you own a tiny slice of industry giants like Apple, Microsoft, Amazon, or Nvidia, even if you literally only have a few dollars to spare. Foundation set? Awesome. Now let's shift gears to part two, your $100 strategy, and how to play the game smartly. Picture this. You take your entire hard-earned $100 and you dump it into one single company. If that company happens to have a bad quarter or maybe a new product completely fails, their stock could plummet 30% overnight, and your money drops right along with it. It's incredibly risky. But on the flip side, by spreading your money out across different companies, you build a protective safety net. If one company struggles, others in your mix might be thriving, which balances the whole thing out. This is called diversification, and it's absolutely key to reducing your risk. So, what's the best way for a beginner to actually get that diversification? Hands down, it's an ETF, or exchange-traded fund. Instead of trying to blindly guess which individual stock is going to be the next big winner, which, let's be real, is insanely difficult even for the pros, an ETF lets you invest in dozens or even hundreds of businesses all at once with just a single purchase. Experts highly recommend ETFs for beginners because they inherently offer a much safer, much broader approach to the market. Let's look at an educational example of how you might actually break down a $100 portfolio. Notice the balance here. 60% is anchored safely in a broad market ETF, giving you that really wide, diversified foundation. Then 20% is allocated to a large tech company for a little bit of targeted growth potential. And the final 20% is just kept ready as cash for future investments or opportunities that might pop up. Even with a really small amount of capital, you can balance growth and safety like a total pro. Keep in mind, though, this is just an educational example to show you the mechanics, definitely not personalized financial advice. Let's keep things moving to our next phase, Section 3, the automation machine, where consistency beats timing. Honestly, this is one of the smartest investing strategies you can ever implement, dollar cost averaging. All it means is investing the exact same amount of money on a regular schedule. It could be $25 every week or maybe $100 every month. The real magic of this strategy is that it completely removes the anxiety of trying to perfectly time the market. You don't have to stress about whether the market is up or down on any given Tuesday. You just automate the whole process. Over the long run, this consistency is what builds massive wealth, and it protects you from accidentally throwing all your money in at the absolute worst possible moment. Of course, knowing what to do is only half the battle, right? We also need to know what not to do. So Section 4 covers common beginner traps and what to avoid at all costs. There are a few very specific emotional and tactical mistakes that cause beginners to lose money in their very first year. First off, steer clear of investing based on social media hype. A trending hashtag is definitely not financial research. Second, panic selling during market drops. The market is going to go down sometimes. That is just a fact. But emotional panic selling just locks in your losses. Next up, trying to get rich overnight. Real investing is a marathon, not a sprint. Also, never borrow money to invest. That amplifies your risk to super dangerous levels. And finally, never ignore basic company research. Successful long-term investors maintain a really calm, methodical mindset, which is the exact opposite of these chaotic, emotion-driven traps. If you can dodge those traps, you arrive at our final stage, Section 5, the payoff and the power of patience. Here's a really crucial takeaway from the material we're looking at today. Time in the market is often more important than trying to perfectly time the market. Short-term price swings, they are totally normal. The investors who actually end up succeeding are the ones who just stay patient, who keep investing consistently through the ups and the downs, and who actively avoid making emotional decisions. It's really all about just letting time do the heavy lifting for you. And that brings us to the core philosophy of this entire explainer. You really don't need to be rich. You don't need perfect timing. And you certainly do not need thousands of dollars to get going. You just need to start. The biggest risk isn't starting with too little money. The absolute biggest risk to your financial future is never starting at all. Remember that single $100 bill we talked about at the very beginning? Taking action with it today could spark an entire lifetime of confident, wealth-building investing. So, to wrap things up, I want to leave you with this somewhat provocative question. If someone handed you a crisp $100 bill today, right this second, which stock or ETF would you research first? Seriously, think about it. Do a little digging, take that literal first step today. Thank you so much for joining me for this explainer, and hey, happy researching!